As expected, Jerome Powell's Fed has cut the benchmark interest rate by 1/4 percentage point. Our guest says markets are expecting the Fed to slow down the pace of cuts or even stop for now. Let's bring in Veronica Clark, economist at Citi. Veronica, thanks very much for coming on the show. I didn't know that. So the market's coming around to the view that Powell could pause the rate cuts for a while?
Yeah, at least if you take pricing for what it is, I think we're pricing around 18 basis points for the next meeting in December. Of course, that's pricing some probability, a higher probability that they will continue cutting, but also pricing some probability that they could pause, they could skip that December meeting. I think there has been, maybe a bit of an overreaction to some stronger data that we've had within the last month. I do think that this is a Fed that is going to continue lowering rates.
You do think, in fact, yourself, that the Fed will feel it should cut borrowing costs still?
Yes, exactly. Yeah, I think this is probably a Fed that is going to continue lowering rates until we get to something at least closer to where a neutral policy rate might be. By the highest estimate that any Fed official has for where that long run interest rate might be, it's we're still 100 basis points away from it. I did take away today that Powell is a lot less worried about inflationary pressures, but the market, of course, is still potentially pricing some of that chance that they might pause.
I mean, could you argue that he has no business cutting rates in that GDP growth is almost 3%, the stock market is surging to record highs?
Yeah, I mean, we had some hawkish comments from Powell today in terms of we have seen stronger data since their last meeting in September. He did really note that we have had some pretty strong GDP growth, upward revisions even to GDP, but their mandate is price stability and maximum employment. And the inflation picture does look a lot better. He said that this is not a tight economy, and the unemployment rate has risen. It's risen by close to 1%, a couple cents below that by from the lows of last year. This is a labor market that's loosened a lot, job growth that has slowed, hiring rates that are where we were in mid-2008. In a lot of ways, this is a looser labor market, and that's really their first mandate.
The backup in bond yields, though, suggests that some investors are apprehensive about inflation. I know bond yields are down a bit today, but of course, Mr. Trump's policies are seen as potentially accelerating price increases.
Yeah, absolutely. I mean, we could see, of course, the wider deficit impact. That's also going to be impacting longer end yields. But there could be some inflationary pressures from upcoming fiscal policy changes. Things like tax cuts, tariffs, of course, which do raise the price level. They're more of a tax than true inflation. But the issue for the Fed is they're going to react to the data as it's coming in. They're going to react to policies and data that they see happening, not what policy and the data might look like a year from now. And so they're going to be very dependent still on current conditions. And Chair Powell even said today that, right now in the near term, there is no impact on policy from, post-election.
Do you think Trump's arrival in the White House means any change of policy for the Fed? I mean, it insists on its political neutrality, of course.
Yeah, I mean, of course, the Fed will react to how, fiscal policies and even trade policies impact the economy. That's what the Fed will be reacting to. But yes, I think they will stay very independent. Chair Powell today was asked a couple times about, the possibility of him resigning or if he could be fired as Fed chair. And he very adamantly said, no, it is not legally possible. So he at least, plans to stay on as an independent Fed chair until his term is up in May of 2026. And in general, yeah, the Fed, I think, will, of course, try to pursue this, independence that they've always had.
And what is your base call for the U.S. economy? Do you see any risk of a recession?
Yeah, absolutely. That's actually, we're still kind of expecting that as we're getting into, end of this year, early next year. And it really just comes down to what we're seeing in the labor market. This has been a very gradual loosening of the labor market so far. But that is usually how these cycles start. You see the unemployment rate very gradually rising, hiring pulling back, hours worked falling, part-time employment rising. We've seen all of that already. And those are, the easy ways that businesses would look to cut labor costs. And we would increasingly be worried that we're getting to the step of more extreme labor cost cutting, which is layoffs. And that's really where, you would expect a sharper rise in the unemployment rate. You would expect that people cut back on spending in a situation like that. So we are still looking for those signs of a more rapid weakening in the labor market.
Contrast the US and Canadian economies, if you would. I mean, we hear a lot of observers saying the US is in better economic shape right now.
Yeah, and in some sense that is true. Of course, it's true. You see it in the aggregate, activity and employment data. The Canadian economy, of course, is just more rate sensitive. So you have people whose mortgage rates have gone up. In the U.S., we have mortgage rates that are mostly fixed for 30 years. So you just have a much more rate sensitive economy. People will cut back on spending, to offset those higher mortgage costs, and that's absolutely what we've seen over the last year, couple years really. And we've seen the labor markets weakening, honestly, in both countries. This big pullback in hiring. The increase in the unemployment rate in Canada has been a bit more pronounced because of stronger immigration and accounting for that in the official statistics. But I do think the U.S. has been very resilient because we are a less rate sensitive economy, but we're not rate sensitive at all. And I do think higher rates are catching up with us.
And leave us with a final thought. In 5 years' time, or let's even make it shorter, if we do get a serious trade war between the US and China, is that a real threat to growth, do you think?
Yeah. I mean, it certainly would be. You would think, of course, tariffs are going to raise price levels. People are going to import less. Of course, you'll get, dollar response offsetting that. But yeah, I do think that would be, near-term growth negative. Of course, the, objective of tariffs, at least, on the surface, is to, bring domestic production, back, reshoring, things like that. Maybe you do get some boost to manufacturing activity, longer run. But in the near term, yeah, this, tariffs would be growth negative. A trade war would probably be growth negative.
Thank you very much, Veronica, as ever.